When people ask me whether they should begin with stocks or with real estate, I usually do not answer the question directly. I ask them why they are asking it now. That question matters because most people do not ask about investments in a vacuum. They ask because someone close to them has just made money. A friend bought a rental property and is talking about cash flow. A coworker bought a stock that doubled. A neighbor says real estate is the only way to build wealth. Someone on the internet says dividend stocks are the easiest path to freedom. Then the mind begins to play a trick. What was invisible yesterday becomes everywhere today. There is a psychological pattern behind this. Once something becomes relevant to you, your brain starts noticing it constantly. If you decide you might buy a particular truck, you suddenly see that truck on every highway. It was there before. You simply did not register it. Investing works the same way. The moment you think about real estate, every rental property story seems to appear in front of you. The moment you think about stocks, every market headline seems to carry more meaning. This is not because the world changed. It is because your attention changed. That is why the first decision in investing is not really whether stocks or real estate build wealth faster. The first decision is how you are going to train your attention, because wealth is not built by chasing whatever your mind noticed this week. Wealth is built by understanding systems, testing assumptions, learning from feedback, and staying alive long enough for compounding to work. And for most people, especially people who are just starting, I would begin with stocks. Not because real estate is bad. I have spent my life studying systems, incentives, debt, cash flow, taxes, leverage, and the way assets behave across cycles. Real estate can be one of the most powerful wealth-building tools in the world. It can create income. It can provide tax advantages. It can protect you against inflation. It can be financed with debt in ways that are sometimes very favorable when the structure is right. But a powerful tool in the hands of someone without competence can also cause real damage. That is the part most beginners do not understand. If you buy a few shares of a high-quality company and make a mistake, the mistake is usually contained. The stock can go down. You can lose part of the capital. You can learn from it. You can exit with liquidity. But if you buy a property before you understand the system, the mistake can grow beyond the money you put into it. A tenant can stop paying. A roof can fail. An air conditioner can die in the middle of summer. A tenant can sue you. A property manager can be incompetent. A local market can soften. Insurance can rise. Property taxes can jump. A vacancy can last longer than you expected. A deal that looked good on paper can become a machine that pulls cash out of your pocket every month. That does not mean real estate is bad. It means sequence matters. The mistake many people make is that they confuse a good asset class with a good starting point. Those are not the same thing. A chainsaw can be useful. It is not the first tool you hand to a person who has never worked with wood. A rental property can be useful. It is not always the first financial instrument you should use before you understand liquidity, valuation, cash flow, risk, taxes, and your own behavior under pressure. That is why I would start with stocks. The reason is simple. Stocks give you skin in the game without trapping you inside a complex operating business. When you buy a small position in a company, something changes in the mind. You stop being a spectator. You start noticing earnings. You start caring about the balance sheet. You start asking what revenue means, what margins mean, what dividends mean, what valuation means, what return on capital means. Concepts that felt abstract become concrete because they now affect you. That is how competence begins. Not by watching 10 more videos, not by listening to someone brag about how much money they made, not by reading another thread from someone who may or may not know what they are talking about. Competence begins when you own something, observe it, and get feedback from reality. This is one of the most important principles I have learned about decision making. You do not learn well when the information is irrelevant to you. You learn when the information is connected to consequences. If you own a share of Coca-Cola, the next earnings report is no longer theoretical. The dividend date is no longer just a term. The price-earnings ratio is not a classroom definition. It becomes a measurement of whether you may be paying a reasonable price for a stream of cash flows. You begin building a map. At first, the map is crude. Then, with repetition, it becomes more accurate. That is how investors develop judgment. It does not happen because someone told them an answer. It happens because they experience a process and compare what they believed with what actually happened. Many people want to skip this. They want certainty before they begin. They want someone to say, buy this, avoid that. Real estate is better, stocks are better, do this exact thing. But markets do not reward people who want certainty. Markets reward people who understand probabilities, consequences, liquidity, leverage, and cycles. Stocks are a good training ground because they allow you to learn with smaller mistakes that matters enormously. Most beginners underestimate the value of a survivable mistake. A survivable mistake is one of the best teachers in the world. It gives you pain without eliminating you. It sharpens your mind without destroying your capital base. It teaches humility before leverage turns your ignorance into a crisis with real estate. Mistakes are often less liquid, more expensive, and slower to repair. So when someone asks me what builds wealth faster, stocks or real estate, I want to slow them down and ask a different question. Which one will help you become competent without putting you in a position where one bad decision can take you out? For many people, the answer is stocks first. From there, I would think about wealth in buckets. A strong personal financial system does not usually depend on one asset class. It depends on balance. It depends on diversifying the types of risk you take. It depends on not being forced to sell at the wrong time. It depends on having cash when opportunity appears. It depends on having assets that produce income and assets that can grow. The model I would use is simple in structure. A portion of the wealth goes into income, producing stocks. A portion goes into real estate. A portion goes into managed or broadly diversified money where you are not making every decision yourself. And a smaller portion stays in cash or cash equivalents, dry powder, gold, Bitcoin, or liquid reserves that give you optionality. The point is not that the exact percentage must be sacred. The point is that durable wealth is usually not built by being one-dimensional. If all your money is in stocks, you are exposed to market volatility and emotional selling. If all your money is in real estate, you are exposed to illiquidity, leverage, tenants, and local market risk. If all your money is managed by other people, you may never build your own judgment. If you hold no cash, then opportunity looks like danger because you have nothing to deploy when prices fall. A good system must account for all of those realities. That is why I do not like the question, should I buy stocks or real estate? A better question is, what is the right sequence for my stage of life, my skills, my liquidity, my risk tolerance, and my ability to handle stress? Most people never ask that question. They only ask what can make them money. That is too narrow. The right question is what can make money, while also improving your understanding and reducing the chance that you make an irreversible mistake. When I say start with stocks, I do not mean gamble. I do not mean buy whatever your brother-in-law mentioned at the gym. I do not mean chase the stock that went up the most last month. I do not mean buy options because someone online made it look easy. I do not mean speculate with money you cannot afford to lose. I mean start with quality. Start with boring businesses. Start with companies that have survived cycles. Start with companies that sell things people keep buying. Start with companies that have paid dividends over long periods of time. Start with companies where the purpose is not excitement, but education, cash flow, and pattern recognition. A boring company can be a very good teacher. A company that pays a dividend teaches you that ownership can produce cash. A company that raises its dividend over time teaches you that growth in earnings can flow back to owners. A company that has survived recessions teaches you something about durability. A company that declines in price while still producing cash teaches you something about emotion and valuation. This is why dividend companies can be useful for beginners. They force you to think like an owner, not a gambler. There's a big difference between owning an asset because you expect someone else to pay more next week and owning an asset because it produces something that has value over time. When you buy an income-producing stock, you can ask simple but powerful questions. Does the company pay a meaningful dividend? Has that dividend been consistent? Has it grown over time? Is revenue stable? Is the business still relevant? Is the valuation reasonable? Does the company have options liquidity if you want to learn how to generate additional income later through disciplined covered calls or cash? Secured puts are analysts and the market generally seeing durability in the business, or is there a major deterioration that you do not understand? You do not need to become a genius overnight. You need to become competent. Competence means you are not guessing blindly. Competence means you understand what you own, why you own it, what could go wrong, and what would make you change your mind. That alone puts you ahead of a large part of the investing public. Most people do not own assets with a thesis. They own them with a feeling. They bought because a price was rising. They bought because a person sounded confident. They bought because they did not want to be left behind. That is not investing. That is emotional imitation. The market is very good at punishing emotional imitation. When you begin with stocks and you do it properly, you learn how to observe without needing to act all the time. You learn that prices move. You learn that companies report. You learn that expectations matter. You learn that a stock can be a good company and a bad price. You learn that a falling price is not automatically a bargain. You learn that a rising price is not automatically proof. These lessons are extremely valuable before you take them into real estate, because real estate has all the same behavioral traps but with more friction and more leverage. People overpay for real estate because they fall in love with the property. They underestimate repairs because they want the deal to work. They overestimate rent because they heard someone else was getting that number. They underestimate vacancy because they have not lived through one. They ignore reserves because cash sitting aside feels inefficient. They use too much debt because the spreadsheet looks better that way. Then reality appears, and reality is a very strict teacher. This is why I want people to build competence. First, real estate is not just a house, it is a business. It includes market selection, financing reserves, tenant risk, maintenance, insurance, taxes, property management, legal structure, cash flow, leverage, and exit strategy. If you do not understand those moving parts, the fact that you can touch the asset does not make it simple. People think real estate is easier because they can see it. Seeing an asset is not the same as understanding it. A person can look at a house and understand that it has walls, a roof, a kitchen, and bedrooms. That does not mean they understand whether it is a good investment. Investment quality is not in the walls. It is in the relationship between price, rent, expenses, debt, taxes, risk, and time. That is where beginners get hurt. They see the house, they do not see the system. With stocks, you can begin learning the system in a more liquid environment. You can buy small, you can read, you can watch, you can compare, you can exit. You can make mistakes that sting but do not trap you. Liquidity is not a luxury for a beginner. Liquidity is protection. If you buy a stock and need cash 3 months later, you can usually sell it. You may gain or lose money, but the asset can be converted into cash quickly. If you buy a rental property and need cash 3 months later, you have a much more complicated problem you may need to sell. Selling takes time. Selling has costs. The market may not cooperate. You may have a tenant in place. You may need repairs before listing. You may not get the price you expected. Illiquidity can turn a manageable problem into panic. Panic destroys wealth. When people are forced to sell because they have no liquidity, they do not sell from strength. They sell from weakness. The market can smell that. This is why every investment sequence must include cash reserves. Not because cash is a great long-term wealth builder. It is not cash loses purchasing power over time. If inflation runs high, but cash gives you options, it gives you time. It prevents one bad event from forcing a bad decision. If you do not have cash, a small problem can become a large problem. If you do have cash, a large problem can sometimes become an opportunity. That difference is one of the hidden foundations of wealth. When you look at the people who survive cycles, they are rarely the ones who predict everything perfectly. They are the ones who avoid being forced into bad decisions. They have liquidity, they have reserves, they do not use maximum leverage, they do not assume calm conditions will continue forever. That is why I would start with stocks, build competence, build cash, then move into real estate carefully. And if someone is determined to get real estate exposure early, there are ways to do it without immediately buying a traditional rental property that can blow up the balance sheet. One way is house hacking. You buy a place you live in and you allow part of that property to help carry the cost. Maybe it is a duplex, maybe it is a triplex, maybe it is a house with extra rooms, maybe there is a basement or accessory unit, you live in one part and rent the other. You learn the landlord business with training wheels because the property is also your home. That is not risk. Free nothing is, but the structure can be more forgiving than buying a distant rental in a market you do not understand. It gives you skin in the game and education while also addressing a cost you already have, which is housing. Another approach is the live in improvement strategy. You buy a primary residence that needs work, you live in it, you improve it after enough time. If the rules apply, you may be able to sell and exclude part of the gain from taxes. This is one of those areas where the tax code can be very favorable when the facts are right and the planning is done correctly. The important point is that the property is not purely a speculative rental. It is also providing utility. You needed a place to live. By improving the property, you may build equity. If you do that repeatedly and carefully, it can become a powerful wealth-building path without the same immediate exposure to tenant and vacancy risk. A third way is through real estate investment trusts. A REIT gives you real estate exposure with stock-like liquidity. You are not fixing toilets. You are not evicting tenants. You are not replacing roofs with your own emergency fund. You are buying a traded asset that owns real estate and pays income. That can be a useful bridge. You can learn how real estate behaves. You can study the types of properties. You can see how interest rates affect valuation. You can see how rent growth matters. You can see how debt affects returns. You can see how management quality matters. And if you need liquidity, you can sell. Again, liquidity is protection. This is not the same as owning a building directly. It does not give you the same control, the same tax advantages, or the same leverage. But for a beginner, it can be a better classroom. A good sequence reduces the cost of education. Bad sequence makes education expensive. I have seen many people learn real estate by buying the wrong property first. That is a painful classroom. It may teach them a lot, but it may also remove the capital they needed to keep learning. You must respect the order of operations. The order of operations in wealth building matters as much as the asset choice. Another danger today is that people learn from sources that sound confident but are not accurate. This is not limited to social media. It exists in newspapers, articles, newsletters, podcasts, and even artificial intelligence tools. Someone who knows a field well can see when a simplified explanation is wrong, but when that same person reads about a field they do not know, they may assume the explanation is correct. That is a dangerous bias. If you are a tax expert and you read a bad article about taxes, you notice the errors. But if you then read a bad article about real estate, you may not notice the errors because that field is not your expertise. This happens constantly. A person reads something oversimplified about buying rentals and thinks it is a complete system. It is not. It may be a story, it may be marketing, it may be written by someone who has never survived the downside of the strategy. That is why you must learn to look through the story into the mechanics. Stories are seductive, mechanics are protective. The mechanics of a rental property are simple to state, but often ignored. If a property rents for $1,500 a month, you do not get to keep $1,500 a month. That is gross rent, not cash flow. From that number, you must subtract taxes, insurance, maintenance, property management, vacancy repairs, capital expenditures, and debt service. You must assume things will go wrong because they will. You must assume the property will be vacant sometimes because it will. You must assume major systems will wear out because they will. If you begin with the fantasy number, the deal will look good. If you begin with the real number, many deals disappear. That is a good thing. The deals that disappear under conservative assumptions were not deals. They were traps waiting for a beginner. If a property brings in $19,500 a month, I would be very careful before assuming I can keep more than half before debt service. Maybe the number is better in some markets. Maybe it is worse. But the principle is that operating expenses are real and they do not care about your optimism. After those expenses, the remaining income must cover the debt. If the debt service is too high, you do not have an investment, you have a liability with a roof. This is where people get confused by appreciation. They say the property will go up. Maybe it will. But if the property bleeds cash and you do not have reserves, you may not survive long enough for appreciation to save you. This is a key principle. You can be right in the long run and still get destroyed in the short run if your structure is wrong. That principle applies to stocks, real estate, businesses, and debt. Structure determines survivability. A good asset in a bad structure can become a bad outcome. That is why I think in terms of systems, not just assets. If I am building a system, I want a stock bucket that teaches me ownership, income, valuation, and liquidity. I want a real estate bucket that gives exposure to tangible assets, tax efficiency, leverage when prudent, and income. I want a managed money or diversified bucket that reduces dependence on my own decision making and lets part of the portfolio work without me constantly touching it. And I want a cash bucket that gives me options and prevents panic. That is how you build something durable. If I had a portfolio, I would not want it to be one big bet. I would want it to be a machine with different parts. One part produces income. One part gives exposure to real assets. One part compounds through diversified management. One part stays liquid when the cycle changes. The machine does not break because it was not built on one assumption. Most people do the opposite. They see one asset working and put everything there. They see real estate rising and think everything should be real estate. They see tech stocks rising and think everything should be tech. They see Bitcoin rising and think everything should be Bitcoin. They see someone making money with options and think everything should be options. That is not a system. That is crowd behavior. Crowd behavior is useful if you are observing it. It is dangerous if you are inside it without realizing it. The intelligent investor should always ask, what am I exposed to? Not just what do I own. Exposure is deeper than ownership. If all your assets depend on low interest rates, you are exposed to rising rates. If all your assets depend on one city, you are exposed to that city. If all your assets depend on one employer, one market, one tenant, one stock, or one economic regime, you have concentration risk. Concentration can build wealth quickly when you are right. It can also destroy wealth quickly when the environment changes. At the beginning, your goal should not be maximum speed. Your goal should be developing a repeatable process that keeps you in the game. If you can survive and learn, you can compound. If you cannot survive, the return assumptions do not matter. So I would begin with a simple stock education, buy quality, study it, understand it, learn dividends, learn valuation, learn balance sheets, learn how prices behave around earnings, learn how emotions affect you when the price falls, learn how hard it is to do nothing when doing nothing is the correct answer, then build liquidity, then gradually add real estate exposure in ways that match your capital and competence. Maybe that means REITs first. Maybe it means house hacking. Maybe it means improving a primary residence. Maybe later, after reserves are stronger, it means a true rental. But do not rush because someone else is on a different chapter. This is one of the great mistakes in life. People compare their chapter 1 to someone else, chapter 20. Then they take risks they are not prepared to take. Someone who owns 20 rentals can survive a bad tenant. Someone who owns 1 rental and has no reserves may not. Someone with a $1 million portfolio can take a 10% position in a speculative asset. Someone with $30,000 of total savings who puts all of it into the same idea is playing a very different game. The same asset can be reasonable for one person and reckless for another. That is why advice without context is dangerous. When I think about a person starting out, I think about what mistakes are likely to happen and how to make sure those mistakes are not fatal. Stocks first is not about saying stocks are superior forever. It is about saying stocks can be a safer and more flexible training ground. Real estate later is not about saying real estate is inferior. It is about saying real estate deserves respect, preparation, reserves, and understanding. The goal is not to win an argument between asset classes. The goal is to build wealth that lasts. And wealth that lasts is not built by urgency. It is built by sequence. It is built by avoiding the big mistake. It is built by recognizing that cash flow matters. It is built by understanding that leverage is powerful but dangerous. It is built by learning before you scale. It is built by treating investing as a craft. Once you understand this, the question becomes less emotional. You stop asking, which asset class is making people rich right now? You start asking, what skill should I build next? If you have no experience, build observational skill with stocks. If you have no liquidity, build cash. If you have no understanding of real estate operating costs, study REITs or house hacking before buying a rental far away. If you have too much exposure to your own opinions, add managed money or broad diversification. If you have too much comfort, study history because history will remind you that every environment changes. This is how I would think about it. Start with what teaches you and protects you, then move into what gives you more power once you are ready. Stocks can teach you valuation, liquidity, dividends, business quality, and emotional discipline. Real estate can teach you operations, leverage, taxes, local markets, and asset control managed. Money can teach you humility because sometimes the best decision is to let part of your capital be run by a process that is not your own mood. Cash can teach you patience because not every dollar must be chasing yield every second together. These parts create a better system than any one of them alone. If you are just starting, do not try to act like someone who has already built the system. Build it piece by piece. Do not dump your entire cushion into a property. Because a person online made it sound easy. Do not trade options with money you cannot replace because someone showed you a screenshot. Do not buy a stock because it is going up. Do not buy a house because you are afraid of missing real estate forever. Fear of missing out is not a strategy. It is a signal that you need to slow down. Good investing often feels boring in the beginning. That is because the early work is foundation work. You are learning, you are building liquidity, you are creating habits, you are understanding what you own. But boring is not bad. Boring often survives, and survival is underrated. The people who build lasting wealth usually have fewer dramatic stories than the people who blow themselves up. They do the same sensible things repeatedly. They protect liquidity. They avoid leverage. They do not understand. They diversify. They study. They let compounding happen that does not get as many clicks, but it works. So when someone asks me whether stocks or real estate build wealth faster, my answer is that the faster path is not always the better path. The better path is the one that builds competence, preserves optionality, and avoids ruin. Start where the mistakes are smaller and the lessons are clearer. Start where you can get feedback without being trapped. Start where you can build pattern recognition. Then, when your capital, liquidity, and understanding grow, use real estate intelligently. Do not reject it. Do not worship it. Understand it. The tax code can favor real estate. Debt can magnify returns. Depreciation can be powerful step up in basis exchanges. And long-term planning can create extraordinary advantages for those who understand them. But those advantages belong to people who can manage the downside. If you cannot manage the downside, the upside is a temptation. The same is true in stocks. A great business at a reckless price can disappoint you. A good dividend stock with weak fundamentals can be a yield trap. An option strategy without understanding can turn income into risk. Every asset has traps. The point is to learn them before they learn you. That is why I come back to principles. Own things you understand. Keep liquidity. Avoid concentration that can ruin you. Do not confuse gross income with cash flow. Do not use leverage before you understand the consequences. Do not chase someone else's outcome without knowing their balance sheet. Build competence before scale. And always ask what happens if you are wrong. If the answer is that being wrong destroys you, the position is too large, the structure is wrong, or you are not ready. If the answer is that being wrong teaches you and leaves you able to continue, you are probably closer to a good learning structure. That is how real investors are built. They are not built by guessing right once. They are built by surviving many decisions, improving the process, and allowing compounding to express itself over time. So begin with stocks if you are new, not with hype, not with speculation. Not with gambling. Begin with quality ownership and income. Let that ownership wake up your attention. Let it make financial language relevant. Let it train your eyes to see patterns. Let it teach you how you behave when prices move against you. Then build the next bucket. Add real estate when you can underwrite conservatively, hold reserves, and handle problems without panic. Add managed or diversified exposure so your whole life is not dependent on your own daily opinions. Keep cash so you are never forced to sell when everyone else is scared. That is not the most exciting answer. It is the answer that respects reality. And in markets, reality is always more powerful than excitement. If you do it in the right order, you do not need to chase, you do not need to copy, you do not need to jump every time someone says they made money. You build a system, you build competence, you build cash flow, you build optionality, and over time those things become much more valuable than the quick excitement of being in whatever asset class everyone is talking about this month. Because in the end, wealth is not built by noticing what is suddenly everywhere. It is built by learning what matters, owning it with discipline, and surviving long enough for the system to reward you.